A magnificent day for the Magnificent Seven as the last of Big Tech reports earnings tonight. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Happy Apple Day.
Happy Apple Day. Is it going to be a happy Apple Day? That's the question, Alex.
Maybe if you get a nice $90 billion buyback, it's a happy Apple Day. Stabilization
you can only
China.
dream.
I don't know. Let's see. All right, the S&P is up by a full 1 percentage point, so you have a definite risk on feel in the equity market, whether you look at the Russell or Big Tech or the broader S&P. To point out Big Tech, I want to take a look at the FANG stocks, because obviously one of the biggest holdings in that is Apple. The FANG stocks outperforming, up by 1.6%. Other asset classes here is not just buy stocks, it's also buy bonds, particularly the front end, continuing that bid after the Fed announcement yesterday. Yields down 8 basis points. And to continue the theme of dollar-yen head scratcher, we're looking at what, $30 billion, $60 billion over this week, potentially from intervention into the dollar-yen. You're now 153.09. I mean, from that perspective, so far, it's worked, quote unquote. Romaine?
All right, well, before we get to the big day on Big Tech, we should really take a look at the complexion of this rally, because it is a lot bigger than Big Tech. The biggest gainer in the S&P today is a trucking company, C.H. Robinson. The biggest decliner in the S&P, a retailer, Etsy. Both moving on the back of earnings, and we're going to spend a lot of time today on earnings, with more than 10% of the Russell 1000 stocks reporting today alone. We've already had a few big disappointments from Cigna, from DoorDash, from Peloton, but that's really being balanced out by some pretty big beats from the likes of Qualcomm, from the likes of Zoetis, and Carvana. Yeah, Carvana, the one struggling automotive retailer, posting its first period of revenue growth after 6 straight quarters of contraction. A conversation on that turnaround in a few minutes with the CEO, Ernie Garcia. We're going to have a few other conversations with CEOs today, including the CEO over at Novo Nordisk. We're going to ask him about his fight to keep up with the frenetic demand for his weight loss drug, Wegovy, and a combo as well with the CEO of Mondelez, the maker of Chips Ahoy, Oreos, and Toblerone chocolate. He's saying he's not yet worried about weight loss drugs, but does have some concern about a loss of pricing power and that doubling in the price of cocoa this year alone. But of course, the star of the earnings parade today will be, what else? Apple, the world's second most valuable company. Actually not looking so valuable as of late, down 11% so far this year. But analysts, they're sticking by the stock for now, saying that even with iPhone shipments likely down significantly, Apple is still a cash-generating juggernaut, and all things tech, Alex, are still going to dominate over everything else in the market. You buying it?
No. But, you know, I'm the kind of gal that has like soup cans and gold under her bed. But the point is, these guys are throwing off a ton of cash. And there was a great piece by Simon White, he's our macro strategist here at Bloomberg, that just talked about how magnificent the magnificent guys really are. So he took a look at the largest 50 S&P 500 firms, it's that blue line, versus the smallest, which is the white line, and talked about just how much money these guys are throwing off. And you're looking at almost $4 trillion here of cash and cash equivalents, et cetera, for those big companies. And Apple is most definitely one of them. Last quarter, their cash and cash equivalents was $172 billion. Just compare that to about $108 billion in debt. Now, what about this quarter? Expectations are for free cash flow to come in about $37 billion. And now we're all kind of waiting for what do they do with all this cash, Romaine. It's not a very friendly environment for big tech to buy stuff. But what if they just bought back their own stock, upwards of, I don't know, $90 billion or so?
All right, well, that gets to your first comment of the day, and maybe we'll pose that question to our first guest of the day. Dan Morgan, Senior Portfolio Manager over at Synovus Trust, joining us right now to help kick us off to the close. Synovus has about $20 billion in assets under management, give or take. And Dan, I'll just take Alex's question there. When we talk about these tech stocks, and particularly Apple, which we know has a huge cash hoard, will continue to have a huge cash hoard, what should it be doing with that cash?
Well, it's interesting, Romaine, because you mentioned the amount of cash on the balance sheet. They also generate about $107 billion in free cash flow. You gave the number on the upcoming expectations for the second quarter. And what's kind of interesting, Romaine, is I've been following Apple for probably about 30 years, and this is very reminiscent to what happened back in 2014. The stock was really floundering. They're having trouble in China. And they came out and they announced a 7-for-1 stock split. They increased their dividend and they bought shares back. And everybody just was in love with Apple again. So, like Alex was saying, if you're not growing your iPhone revenues, which are expected to fall 10% on this quarter, you've got issues in China, your top line growth is expected to fall 5%, why not go out and do some sort of increase in dividend, buy share backs, whatever, to generate interest back in the stock, because you're not growing, so how else do you do it? And it's very reminiscent of what we saw in 2014.
I hate to say this, Dan, but is this time different in that the pressure in China is quite a different type of pressure than maybe what we saw back in 2015, 2016?
Yeah, I mean, the Chinese issue is different, you're right, Alex, because we didn't have so much regulatory issues, right? You've got Huawei increasing market share, then you've got bans on iPhones that for people who work for the government. We never had that back in 2014. It was more just an issue in terms of competition and how they were meshing up. So I think you're right. I think the China issue is more of a systemic issue. This quarter, we're looking for about 20% of the revenues coming from China, about a 10% drop from we saw a year ago. And it seems like every quarter, year over year growth is negative coming out of China. And, they've got to work a way to try to get around all these regulations and so forth to try to turn things around. But Good point, Alex. They didn't have the same governmental bans back in 2014 they have today. It was a more competitive issue.
I'm curious, Dan, when we start to talk about Apple not necessarily being the growth company that it was, and just to be fair, there are a lot of investors that basically have said for a while this company stopped being a growth stock and much more of a value play. But this is still a company that I think both investors and consumers alike want to see come out with new products, want to see that innovation. We've got a big event scheduled for next week. There's been a lot of speculation as to whether Apple will finally articulate a broader AI strategy. Do you have any hopes, any high hopes, that we're going to learn something next week?
Romaine, I'm always optimistic about Apple. We put it on the buy list back in 2005, and our split-adjusted basis is $1.26. And every time people have doubted the stock, they have somehow found a way to grow. And you brought up the May conference. They're going to be coming out with supposedly a new tablet. They also have the developers conference in June, which everybody's excited about, that they'll eventually, unveil some sort of Gen AI roadmap. And then, of course, we move to September. You've got the new iPhone 16, the iOS 18. So there's a lot of opportunities along the road, Romaine and Alex, for Apple to come out with an announcement that everybody gets really excited about, and we get back invigorated with the stock again. And I'm an eternal optimistic about Apple. I expect them to come up with something here in the next 6 months. So we'll just have to see how it plays out.
Okay, come up with something. What are they going to have to pay to do that in terms of CapEx? I mean, Meta put a number on it, right, and it gets punished. Amazon doesn't, and they don't get punished. But you got to spend the money to do the AI.
Yeah, you're right, Alex. And up to this point, Apple really hasn't come out with any huge AI strategy, right? They came out with a chip. They have something called Ajax. It's going to be like an assistant. They signed the deal with Alphabet in terms of Gemini, which will now use their software on their phones and so forth. But there hasn't been that earth-shattering idea of what they're doing forward. And everything they've done to this point, if you've listened to their conference calls with Tim Cook, they've been very focused on integrating AI into their existing product portfolios and not really reaching out and coming out with some new thing that no one's ever heard of. So maybe they have something up the sleeves that they'll be able to unveil here at these opportunities in these upcoming conferences that we talked about. But at this point, it's been kind of a benign AI strategy coming out of Apple.
All right, Dan, always great to talk to you. Dan Morgan, Senior Portfolio Manager over at Synovus. A lot going on after the bell with those results out of Apple expected later tonight, but a lot going on right now here in the cash session for Paramount. Those shares surging right now on the back of reports, including from Bloomberg, that Sony and Apollo have made a proposal to buy the company. $26 billion on the table, said to be on the table. Bloomberg Technology co-host Caroline Hyde joining us to talk a little bit more about this. If this is indeed true, Caroline, this would be a much richer deal than what Skydance had proposed.
And this is why you're seeing the non-voting shares, those Class B shares, super popping on the back of this, because they've been beaten up. The idea that originally it was going to be Sherry Redstone, the controlling majority shareholder, and actually only about 10% of the free float overall, getting a premium vis-a-vis the non-voting shares is what really irked a lot of investors in this name. Now, they've been pushing for a more open bidding perspective, because remember, David Ellison has got until Friday, we understand, to have these exclusive talks. We're being joined by Redpoint as well to come in and basically buy out Sherry Redstone and then offer some sort of premium sweetened sort of deal to the voting Class B shareholders, non-voting Class B shareholders. But now, could there be a bigger offer on the table with a really strategic player as Sony? That is what some shareholders are really loving the sound of. We got to speak, of course, with John Rogers, who's over at Ariel Investors, held this name since 2006. This is what he had to say prior to this news. Just take a listen.
If this transaction really is focused on Skydance, we think that that may possibly have a chance to work, but we really would much rather see the Apollo deal with Sony that's been so rumored to be out there to get certainty.
And the reports are that there would be from Sony and Apollo. Sony would take the majority stake here, it would seem. Apollo in on that new venture, but ultimately they'd be taking the debt and paying a premium to all shareholders.
That was a great interview that you guys did, by the way. And it was so nice to have a shareholder that believes in the company come out and be like, this is what I want. I've been in these situations before. This is not how it's done, right? So do we expect more now offers from different players to come in once this exclusive time is sort of checked the box tomorrow?
There were rumored to be other names involved, but ultimately the only one that we've really been guided towards is an Apollo and a Sony. Now, the only caveat to that sort of a deal is, well, regulatory concerns. Can you really have Sony that's so interested in the back catalogue, the movie making, the content? Really, can they team together and be another really big, bulky player in the space? John Rogers did say, look, he felt from a regulatory perspective, this is not a worry. But I do wonder, the key for the non-voting shareholders is that this is more open, that this is clearer, and they get the full appreciation of ultimately the assets he sees. Yeah, more money actually, and not a bet on generative AI. You're just talking generative AI. That's the David Ellison offering, and the Oracle expertise from his father is, look, you can inject AI and do more with content.
Well, that's going to be the big question here, because this is more than just the financial story. This is also about the strategic partnership going forward here. And who do you think is going to ride that better, Sony and Apollo, or David Ellison and his team over at Skydance? Caroline Hyde, co-host of Bloomberg Technology, a breakdown here of that rally that we're seeing in Paramount shares. Stick with us. A lot more coming up here on The Close. This is Bloomberg.
The best performing stock in the S&P is actually a logistic company, and it's not just that company, it's also RXO, the freight and transportation company in the green today, up by over 6%. First quarter revenue did miss analyst expectations. On the plus side, brokerage volume is up 11%. That's like the juicy part of their business. And it has the largest sales pipeline since 2020. The CEO, Drew Wilkerson, joins us now. Drew, basically, you try and make it easier and better and clearer to help companies ship stuff when, where, and how within the U.S. Based on that window and that lens, how would you describe the U.S. economy right now?
Yeah, right now, if you look at the overall macroeconomy, it's held up relatively well. Supply chain inventories are in a much better position than where they were last year, but you still have your overall freight demand, and we're in a soft freight environment, has been down on a year-over-year basis for the second year in a row. So for us, we're extremely proud of the fact that we grew volumes by 11%, because right now what we've seen is our customers are reducing the number of carriers that they're working with, and we've been the beneficiary of that.
If we look at it on a revenue per load basis, though, and we adjust for, say, how long the haul is, your mix and changes in fuel prices and all of that, that declined about the high single digits in the first quarter. As to you say, like, we're still in a softer freight environment. What gets you back to positive? How long does that take?
We talked on the call that was going to get better again in the second quarter, and we said that our truckload revenue per load was actually going to exit close to flat, if not flat, for the second quarter. So you're starting to see that. And on our earnings call, we talked about the fact that right now, we do believe that this market will turn at some point over the next year. And so we priced our business accordingly, because we want to give customers rates that we can honor, and where we're going to accept the tenders from them, because that's one of the most important things for customers. Are you going to get the service, and are you going to get the tender acceptance out there?
Is the issue right now, though, Drew, I mean, when we talk about the performance of your company as well as your peers, is the issue right now one of demand, or is it still one of capacity, or rather overcapacity in the trucking space?
There's still way too much capacity in the overall trucking industry, but demand is down on a year-over-year basis. It's a mixed bag between the two. I believe that there has to be a lot more capacity that comes out of the market before you start to see that inflection. So I think that right now is probably late 24 or early 25 before you see that.
We've seen quite a few companies go under, a couple big ones and obviously a couple of small ones, at least over the last, 6 or 7 months or so. Is there some sort of threshold you're looking to where you think capacity will be more in line with demand?
Well, if you look right now, carrier rates have hit a bottom, and the carriers are actually operating at a rate below what their cost is. And so if you think of what happened back during COVID, rates were at an all-time high. You had PPE money coming in to small trucking companies. So they were able to build up a strong balance sheet, and they've held on longer than I think most anticipated, including us at RXO. So we've got to see more capacity come out so that you've got an equilibrium,
right,
or you can see more demand pick up in the macro to support the amount of capacity that's out there.
Well, I am curious then, because when we talk about balance sheets, for example, I think it was back in March, you had Moody's come out. They're taking a look, obviously, at your debt ratios, 2.5 times, basically saying that puts you at a threat of a downgrade. If you can get that down to 2, that puts you maybe in the realm of an upgrade. But in saying that, they were also pretty clear that Moody's thought, that the second half was going to start to see those freight volumes pick up significantly here. Are you in sync with the narrative that Moody put out a couple of months ago?
I think that we still don't know yet, Romaine. When you look at what's going on in the market, demand is still down. So, if you look at what consumers are still spending their money on right now, they're still spending their money on services. And, for the freight market to start to recover, you want to see them start spending the money on goods again.
And do you think that's going to happen? I mean, everyone keeps talking about, consumer spending's coming down. Are you confident in that?
I don't have a crystal ball on that. I think a lot of that's going to depend on what happens with the Fed, what happens with the election. I think there are so many things that are going to impact what the consumer is going to do over the next 6 months. So I don't necessarily want to put out a prediction for where that lands.
All right, fair enough. Drew, always appreciate talking to you. Drew Wilkerson there. He's the CEO over at RXO. A lot more coming up here on the big program. This is The Close on Bloomberg. All right, it's time now for our top calls. A look at the big movers on the back of analyst recommendations. We're going to start today with Tesla. Cantor Fitzgerald starting coverage of the EV maker with an overweight recommendation and a $230 price target. The analysts excited about Tesla's full self-driving program after China approved deployment of the software. The analyst also cites long-term upside from that potential robo-taxi rollout and the introduction of lower-priced models. Shares a modest bid on the day, up about 0.4%. Next up, let's take a look at Meta, a rare sell rating for the company. Stefan Slowinski over at BNP Paribas Exane picking up coverage of the company and starting out with an underperform and a street low price target of $360. Slowinski hints that Meta's year of efficiency, that might actually be depleted, and he doesn't see Meta having new revenue streams to replenish those resources. And while generative AI can help with efficiency and cutting costs, the analyst says it's proving a bit too expensive, at least at the moment, for Meta to execute. Nevertheless, the share is higher by about 1% on the day. And finally, let's take a look at Freshworks. This is the cloud software company, and it got hit with a few downgrades this morning after cutting its annual revenue forecast and announcing a CEO transition. The folks over at Oppenheimer saying challenges surrounding new leadership and execution won't allow Freshworks to reinvigorate top-line growth anytime soon. Oppenheimer downgrading to market perform. Investors bailing out of the stock, sending it down on its worst day since it went public about 3 years ago. Those are our top calls for the day. But we do want to stay in the sell-side space and take a look at, one of the biggest movers of the day, also going through a change in leadership once again. We're talking about Peloton. The CEO, Barry McCarthy, he's stepping down after just 2 years on the job. Peloton also cutting about 15% of its staff as part of the restructuring, and a lot of investors now really wondering what comes next. Bernie McTernan joining us right now, senior analyst at Needham. He has a hold rating on the shares, a hold rating that I believe you downgraded last summer when we were dealing with a lot of turmoil in this company. And I thought Barry was supposed to be kind of the salvation here. Is this kind of, I hate to put it this way, Bernie, but is this kind of the beginning of the end?
Well, so that's the key question here. And I think Barry did a good job at right-sizing the cost structure, considering the position they were in, the inventory levels they had. So they've done a good job for that. But at the same point, for the stock to really work from here, you need revenue. Oh, one of two things, either revenue growth or really significantly cut costs here. And so I think that that's ultimately the toughest thing for the company. They were talking about some green shoots that they're seeing in terms of the connected fitness market, potentially getting back to growth again. But we just haven't seen that in quite some time. And really the big learning over the past year and a half or 2 years is that the connected fitness market just isn't as big as we thought it could be. And we think that that could potentially stop a strategic from wanting to make an acquisition of the company. And then if you're going down the M&A angle, we think private equity is probably more likely here.
Okay, that's interesting. I was on radio earlier, and it was more like maybe one of the tech guys. Like, does an Apple want to come in and buy Peloton?
Yeah. And so, well, first off, I think that going back to the point on TAM being smaller than we anticipated, they have bigger fish to fry right now with generative AI, even Amazon trying to conquer the grocery delivery market in the US here. So I think that's one piece. And then once you start talking about a Nike or a Lululemon, I think there's question marks too in terms of what with Lulu's failure with Mirror, what adding a connected fitness product can do for apparel sales. And that's why I see a company that's spending $700 million on fixed costs right now. They're spending $600 million on sales and marketing, and their revenue is not growing. So that cost structure doesn't match the growth with the company. And that's why the private equity angle intuitively just makes more sense to me than a strategic at this point.
So if we do end up with kind of a take-private situation here, it still raises the question about the business model, not just Peloton, but really for a lot of these fitness products that came out during the pandemic. Is there still life there? Excuse me.
Yeah, well, I think it's a great product. I am a Peloton subscriber. I think that there is a valuable use case in terms of saving time, in terms of really, comparing Peloton to like a Barry's Boot Camp or another in-person class. It is a much cheaper option. So I think that there's the potential. But again, we're seeing subscribers really haven't moved off this 3 million level. And so that's the real question is there growth here? And if there's not, then it's really you need to right size that cost structure. And I think that's the future of the company. And really with Barry's old contract, he wasn't going to get materially paid unless the stock got back to $40. And so there had to be growth to be able to drive that. You couldn't just get through cost cutting. So I think there was a misalignment of incentives ultimately when growth was stalling out.
Maybe 40 made sense when the stock was at, 60. But now $3, I don't know. All right, Bernie, thanks a lot. Bernie McTernan over at Needham, we appreciate it. But the thing is, Romain, is that people who are Peloton users, they love it. They're addicted and will go to the wall for it. But how do you grow that base or monetize that base more?
You can. That's just it. Those people, they get you so far, but at some point you've got to expand beyond that. And maybe that was what they did. And that was all the expansion that was there. Anyone who wanted one got one. And now, I don't know, the world has moved on, Alex. Yeah. Do you have a Peloton?
I do not.
Did you ever have one?
No, New York apartment, man. Who has space for that? I'm sure some people do. I am not one of them. All right, coming up, we're going to take a look at another company that shares are definitely moving. Carvana, cruising to session highs after better than expected first quarter report. Our conversation with Ernie Garcia. He's the founder and CEO. Coming up next on The Close. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Alex Steele. Welcome to Apple Day. We're an hour away from Apple. A lot to prove, it feels, for the market.
Yeah, interesting too. Obviously it's one of the biggest laggards, at least among the big cap tech. Sans Tesla here. So I don't know. Maybe the bar is so low that no matter what they say, maybe we get a rally out of it. But
which is very Apple, by the way.
Yeah.
An under-promise, over-deliver kind of system setup. So that would be quite interesting. Another stock that I feel like if we had thought this was going to happen, we would have been surprised a couple of days ago is Carvana.
Yeah.
Up a whopping multi-digit percent.
This is an amazing turnaround. Remember, there are a lot of people that really had left this company for dead just about a year ago. And they've really bounced back both in terms of their revenue growth. And I guess they're improving as well on the bottom line, too. So it'll be interesting to see whether they can continue that. Yeah,
sales, profit, way above what the street was calling for. Apparently, they saw about 16% rise in cars sold. The profit beat had a $75 million gain on the value of warrants that Carvana holds in insurer Root. So that was part of it. Joining us now is Ernie Garcia, founder and CEO of Carvana. So many questions. Great to have you. Thanks for joining.
Great to be here. Thanks.
What do I learn from your numbers? Is it a macro read on where the U.S. economy is, or is it an operational read on what you guys did at Carvana?
Well, I think it's a macro read on where the U.S. economy is, or is it an operational read on what you guys did at Carvana? I think it's a macro read on where the U.S. economy is, or is it an operational read on what you guys did at Carvana? I think it's a macro read on where the U.S. economy is, or is it an operational read on what you guys did at Carvana? I think it's the latter. I think our team has done an incredible job the last couple of years. As you said, we had 22 and 23 were pretty tough for us after an incredible run from 2013 through 2021. We were growing very fast, and customers were migrating more and more to online purchasing of cars. When we went through that period, I think the team came together. We responded incredibly well. And I think this quarter is undoubtedly the best quarter we've had in our history. It's the result of a ton of hard work. It's a result of the team coming together and doing an awesome job. So to all of you out there, thank you very much. Great job.
When we take a look at some of your profit margins, I mean, it looks like you're making like, what, $3,000 plus for a car. This is so much more ahead of your competition. How do you do that? And how do you keep growing that? And is that sustainable?
Sure. Well, let me start with this. I think, what we're most proud of is when we set out to try to build Carvana, we wanted to give customers the best deal we possibly could. We wanted to give them a better deal than the competition. We wanted to give them an experience that was simpler, a broader selection. And we wanted to build a business model that could ultimately have higher returns than the traditional business models had. And that's very difficult to do. The only way you can do all those things at once is to build a completely different business. And so, we've built a transaction flow where customers can go through on their own. They can get approved for financing. They can select the car. That can take seconds. They're in control of the entire thing. And then we've built an entirely new supply chain underneath it with reconditioning centers and logistics that allows us to give customers access to a nationwide inventory and ship cars around the country. And the economics of it are just very different. There were a lot of fixed costs in building that system, but the variable costs are much lower. And then we're monetizing it more completely by being more vertically integrated. So it allows us to check all those boxes, and hopefully we keep doing the same.
There was a lot of discussion, prior to this year about the debt load, Ernie. I know that at least that's stabilized. Do you anticipate that we could see a reduction on the balance sheet this year, a significant reduction?
Yeah, so I think, we made the statement yesterday in our earnings call that we plan to pay cash interest on our bonds over time. We do plan to de-lever over time. And I think all that's enabled by the incredible progress we've made. We were extremely proud to report $235 million of EBITDA in Q1. You annualize that, it's about $1 billion a year, and we're 1% of the market. So, we clearly are sitting in front of a huge, huge opportunity, and it's our team's job to execute really well into that opportunity. I think we're going to have pretty great things in front of us if we do.
As part of that opportunity, are you able to acquire cars at a more reasonable, or I should say a more favorable price than maybe in the year past?
Sure. So I think, part of our business is buying cars from our customers. So customers can go to our website. We'll give them a value online and in minutes, and we can come pick up the car from them as soon as the same day, or they can come drop it off to us. That's the way we get the majority of our cars. That's an experience that customers love. They can get paid quickly. It's an experience that we're well positioned to provide because we have that underlying logistics network that allows us to buy cars from them and then ship them to wherever they're most valuable. There are oftentimes differences in car values around the country, so we can buy them wherever they are and then sell them in the places where they're more valuable, and that works out great for our customers that are selling cars because they get a great value, and also great for our customers that are buying cars because they have access to such supply.
Is there any sort of trend line that you've seen in terms of the types of cars that people are gravitating to right now?
I think it's first order. The most interesting storyline there is probably what's going on with EVs, and I think the EV market generally looks a lot like the used market, but it trails. And so, last year EVs were around 1% of used car sales. They were around 7.5%, give or take, of new car sales. This year they're starting to ramp up, and they're heading in the direction of where new cars are. New cars are also growing as well. So we've seen more demand there. But I think in general, it's, customers have been looking to save money as car prices went up and as interest rates went up. So we've seen that as a multi-year trend, but nothing too notable beyond that.
Are the high borrowing costs for cars at all, or for auto loans, affecting at all what people are buying and what price point, et cetera?
Yeah, I think, car payments are basically the sum of the interest rate environment and the car price environment, and car prices are higher than they were pre-pandemic, and interest rates are also higher. And so car payments for customers are higher, even on an inflation adjusted basis. They're probably between maybe 5 and 20% higher than they were pre-pandemic. So that has people trying to save money. And we've seen people trading down to cars that are a little bit older with a little higher mileage. But then over the last 2 years, as we've seen depreciation, we've seen customers start to migrate back in the direction that they were prior. So our best guess is that probably continues. But I think, people are trying to find a car that fits their life.
All right, Ernie. Well, this was certainly a phenomenal quarter. And as you know, all eyes really right now on this company and how you execute going forward. So a lot of expectations for you to keep this up, and we'll definitely check in with you over the next few quarters. Ernie Garcia, the founder and CEO over at Carvana. And Alex, sticking in the automotive space, and I thought it was interesting, he's talked about all these EVs coming to market, to the used market. And what does he say, 7% of sales, which is a big change. A lot of those are Teslas. And it's kind of interesting, Tesla's grappling with its own issue of trying to how to keep people buying its new cars. A lot of layoffs over there. We forgot, you lost finance chiefs, you lost the head HR, you lost the supercharger team. Now, apparently, Alex, if you had an internship lined up with Tesla this summer, you're out of luck.
That's kind of rough, I have to say. So apparently they rescinded offers just weeks before internships were set to start. Like, okay, I never interned. I was always working. I had to make money during the summers. But if you decided you were going to live somewhere during the summer, you rented an apartment, you did all the legwork, and you weren't getting paid, that stinks.
Yeah, I mean...
Also, they're free, right? Or at least they're super cheap.
Well, I actually think Tesla paid their interns.
I think some of them are unpaid.
Some of them, Alex, a lot has changed, since way back yonder when you were...
I was waitressing, man. Whatever. This is Bloomberg.
We got to go.
We will gradually be expanding manufacturing throughout the year and also into coming years. So we are committed to bring our innovation to more and more patients on a gradual basis.
Lars Jørgensen there, the CEO over at Novo Nordisk. I had a chance to catch up with him earlier. He talked a lot here that right now what ails that company isn't demand. It's basically fulfilling that demand, ratcheting up capacity in order to pump out more of that Wegovy, more of Ozempic here. One thing I did not get to ask him, Alex, and I really wanted to, ask him, is he getting a lot of calls from snack makers and food companies and basically just shivering in their boots that Wegovy and Ozempic is just going to ruin them all?
So I asked him that actually last time he was here in studio, and he was like, yeah. Some of them are actually calling and being genuinely freaked out by it. Speaking of, Romain and I sat down with the CEO of Mondelez after an earnings forecast miss. And here's what Dirk van der Put said about the impact of these weight loss drugs.
As you can imagine, we monitor this quite carefully. We have models, we discuss with the drug makers, we follow very carefully the consumers that are on the drugs, how do their habits change. And for us, knowing the things that we know today and the curve that we see of adoption of the drug, everything is in line with our models. And those models predict that in 10 years' time, it will have an effect of between 0.5 to 1% of our volume, which is basically a margin of error for us. So now things can change, but so far we've been monitoring this for the last year. We do it every quarter. Things have not been different than what we have been forecasting.
We did see pretty decent revenue growth, particularly on the organic side. You had decent growth in margins and, of course, decent growth on the bottom lines. Investors, though, are raising a lot of questions here about what the cost structure is going to look like for the quarters going forward and whether you can maintain that full-year outlook.
Yes. Well, at this stage, the costs that are really causing us to pay very close attention is in the first place, of course, cocoa. There's a lot of discussion. There's also some sugar and some labor costs. But as it relates to the year, I would say on cocoa, we're fully hedged now. We have a pretty good idea on the sugar costs, and labor is also pretty clear to us. So we feel that our forecast for the year, staying in line with our financial algorithm, is going to be sustainable and that we will deliver a year as originally announced.
On the point, though, of cocoa prices, even though you may have locked in your prices for the year, if we do see prices remain elevated, and most folks in the market seem to think that cocoa is going to kind of stay where it is right now for the next few months, when does that become an issue for you as you start to plan for 2025 and beyond?
Well, it is already an issue. The big question, of course, is how to hedge for 2025. We have a number of different techniques that we use. We monitor the market very carefully, and then we will lock in at the right moments. It is expected that cocoa will come down eventually. That's probably going to be more around the September-October timeframe. Why? Because that's when the main cocoa crop will become clearer and people will have an idea what it's going to look like. There is a mid-crop. There's 2 crops of cocoa in Africa. The mid-crop looks like it's pretty good, which we are having data around now. That's why you've seen cocoa come down a little bit in recent weeks or days. And so the big moment is September, October. In the meantime, cocoa will go up and down. There's not a lot of trading taking place. There's a number of traders exiting. So at those moments, we will take the necessary steps for next year.
So Dirk, does that mean that you're hedged throughout the rest of this year?
Yes.
But not in 2025?
Already a part of it. I can't go into our hedging strategy, of course, but yes, we have already taken some positions for next year.
Based, though, on the volatility, and I'm assuming it's very complicated to hedge when prices are so whippy like this, is that why you're increasing your non-chocolate offerings? Like, do you need to put more money into that?
Yes, well, we will need to continue to support chocolate, as you can imagine, even if we hedge well and so on. Where our cocoa price is this year versus last year, and where it will be next year versus this year, there will be an increase. So chocolate prices will continue to increase, at least for the remainder of this year in 25. And so we will have to advertise, we will have to promote, we will have to support our chocolate business.
That was Mondelez CEO Dirk van der Put joining us earlier. That stock flat on the day. Much more ahead as we have a nice rally underway, just about 15 minutes to the close of trading. This is Bloomberg.
This is the countdown to the close. I'm Romain Bostic alongside Alex Steele. 10 minutes, Alex, until we get to those closing bells here. A little bit more of a bright spot today than where we were yesterday. Does that change in a few minutes?
Yeah, right. And really around the highs of the session, too. You got the Russell, the S&P, you got the NASDAQ, you have NASDAQ 100, all really outperforming. But what I find so interesting, we talked about this earlier, C.H. Robinson is one of the best performing stocks within the S&P. I think currently it's number 4. That's a logistic trucking company. Yeah. Right? I mean, that's not sexy, that's not AI, that's not tech. That's straight up real economy.
It's not. It's real economy. It's also, I think, a reflection of low expectations, right? I mean, and maybe that's what Apple has going for it. Maybe. It's so beaten down that even if they report something bad, then I guess maybe, I don't know, that'll be enough.
I don't know. But they probably do use AI, too, maybe somewhere there.
All right, well, stick with us here. Apple earnings scheduled to come after the bell tonight. We'll have full coverage in just a few. But before we get to those bells, let's get to Dan Suzuki, Deputy CIO over at Richard Bernstein Advisors. He'll help count us down to those closing bells here. And a little bit more optimism in the market over the last couple days, I guess. I mean, it's better than, I guess, whatever April gave us. But what is that predicated on? I mean, is there a real catalyst here for this market? I mean, earnings season, we're kind of through it. The Fed has basically said what it had to say. And now we're just kind of at the mercy of what?
Of growth. Yeah. I think it's really earnings growth and fundamentals, kind of plain old boring stuff. And that's what's improving. That's what's got a lot of momentum. And importantly, it's not that it's just improving, but it's broadening out. And so you're talking about small caps participating, C.H. Robinson participating. I think that's what's getting people excited. It's not just a narrow story of a handful of stocks. It's like a lot of stuff out there.
And most of the big movers today, at least to the upside, are kind of more real economy, if you will, rather than just the hopium of AI and tech. But I guess it raises the question then, where do you look at the economy right now as an investor? I mean, is this the type of, I guess, economic growth where you look to it and you say, okay, now you get on the cyclical bandwagon?
I think you do, but you have to be careful. I think what's the part of the type of growth that we're getting here is nominal acceleration in growth. And that nominal is important because inflation is a big component of this. And so if you look at since the market peaked, back in February, what's performed the best, it's not just some of the cyclical stuff, but the stuff that benefits from inflationary growth. So whether it's commodities or the commodity producers or the commodity producing countries, you're definitely seeing a theme there. And I think that's critical going forward.
So what are kind of the cyclicals or the growth stocks that you don't want versus the kind that you do, that can benefit an inflationary environment and that also are good value?
Well, I think there's a couple of dynamics here, right? I think one, there's some cyclicals where they've had their acceleration, but now they're on the other side of that and they're slowing. I mean, it doesn't matter whether it's cyclical or defensive. You don't want the companies where their earnings are slowing. So those are the mega caps. They were a big driver last year, and now they've kind of peaked, and they're still really good, but they're slowing. Other areas are just a little bit more mixed. Like financials is probably a little bit more mixed, even though it's a traditional cyclical. Consumer discretionary tends to not do well late in the cycle when inflationary is picking up, when you're worried about the Fed. People stretch their budgets, and that's sort of, you have to be a little bit picky and choosy. Late cycle companies are industrials, materials, energy, partly because they benefit from that higher inflationary dynamic.
Yeah, it was interesting, sort of the theme over the last couple of days with consumer stocks, which is like the low end is really struggling, and there is like a value war that's kind of shaping up that's going to do kind of no one any favors from that end. Where do you think we are in the late cycle part for these stocks?
Listen, I don't think of late cycle to mean there's a countdown clock, and so we're like 2 hours away or 1 hour away. I think of really, what defines late cycle is the economy is now tight. And I think that's clear everywhere you look. The economy is tight. And so when the economy gets tight, better growth, the stronger that growth is, the more inflationary it is. Because you want to build another widget, well, you got to hire workers and you got to compete because there's no, you have to pay those workers a lot more. You got to build a new factory because your factories are running 3 shifts. It's just a lot more inflationary in nature. And I think that's where we are late cycle.
Well, I'm curious, though, what did you make, though, of what Jay Powell had to say yesterday here? I mean, I know it wasn't unexpected, but it still seemed like a lot of people aren't necessarily comfortable with where the Fed stands right now.
He didn't really say a whole lot, right? I mean, he basically said, there's been a repricing of Fed expectations, and that makes sense because the immaculate disinflation story is going to be a lot harder than what they thought. Inflation's a lot more sticky. Mm-hmm. That's basically all that he said, which is what the market already priced. That's why, you had like a lot of up and a lot of down, and ultimately the market ended where, the market began after the press release. So. Mm-hmm. I think that's kind of where you need to shift to because, before he starts to talk about hikes, if that's going to be the scenario we go down, he has to take away, those cuts, and that's what he kind of has moved towards.
So for equity investors then, I mean, are we at a stage now where bond yields and some of those ancillary sort of pockets of the market, do they matter less in terms of correlation?
Well, that's the interesting thing because you are seeing the correlations pick up, relative to those big parts of the market. I actually think those yields are going to matter more now, right? Because we've actually had a bit of a rally in yields, but just in general, you get closer to that 5% point. I think the market gets a little bit more sensitive. Again, that tightness of the economy, that inflationary pressure, that's where up until now it's been good news is good news. We just love the better growth. Now that good growth is pushing up and reaccelerating inflation, I don't think the market is uniformly going to like that so much. So it's really about picking winners and losers off of that.
Small caps, winner or loser?
It's funny because the narrative is loser.
You sound like you want to say loser, but
the narrative is loser. But if you pull up on the on the Bloomberg terminal, just look at changes in the 10-year yield versus the relative performance of small caps versus large caps. When yields are going up, small caps are generally outperforming. We have a great chart. I'll share it with you later on the terminal. But it's a pretty consistent pattern.
Do you not want to share it with us now?
I'm not even logged in. I got to do a finger swipe.
Dan's not prepared.
All right, putting Dan Suzuki on the spot. Dan, always great to catch up with you. Dan Suzuki, Deputy CIO over at Richard Bernstein Advisors. He's helping us count down to those closing bells. We're just about 3 minutes away, Alex. And before we get to the broader market, which is now hitting fresh session highs, just want to point out here a huge spike in Nordstrom shares just in the past few minutes, up about 10%, now up about 6.5%. This on the back of a Reuters report that Sycamore has expressed interest in taking the company private. Of course, we know the Nordstrom brothers, the 2 surviving brothers there, have basically made a formal proposal to the board to take this company private.
Right, I was going to say, didn't we know this? Like, weren't there lots of kind of bids that were coming in? Like, the worst kept secret is that this is going to go private at some point. It's just a matter of how.
And it's a matter of who.
And who. Who, how, what price, yes.
Yeah, absolutely. So anyway, a little bit of a bid there as we head towards the close. Of course, once we get to those closing bells, a big focus is going to be back on big tech, Alex, and Apple. Yep. Do we still call it Apple Computer? Just Apple Inc.?
No, but Paul Sweeney did that on radio, and I was like, what are you, 105 years old?
I know.
Like Apple Computer?
I heard that. That was like a pretty funny moment there. Let me tell you, the most entertainment I get here is when I listen to radio, whenever I'm in the Bloomberg facilities.
Cool. Nowhere to go from there. But you're looking at the NASDAQ is up by about 1.5%. Volume also super solid as we head into Apple after the closing bell.
All right, the S&P up about 0.8%. The NASDAQ up 1.5%. Stick with us. We're about to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined right now by Scarlett Fu, as well as Carol Master and Tim Stenovic, as we welcome our audiences across all of our Bloomberg platforms, television, radio. That partnership, Carol, it still exists with YouTube. Here on a pretty good day in the markets as we await those earnings out of Apple.
Unless you're trying to short the market on the equity side. Just
who would do that, Carol?
People do that. Two sides to every trade. Having said that, you look at the S&P.
Wow, I learn something new every day.
I know. Markets 101. Welcome, everybody. All right, S&P 500, you've got more than 300 names to the upside right now. So you definitely feel like investors are willing to play in this market, especially when it comes to some of those big tech names.
Yeah, we're 30 seconds into this and nobody's talked about Apple earnings yet. Coming at 4:30.
Apple reports?
Higher by more than 2% today. Is there going to be anything regarding a buyback, additional buyback announced? What does China look like? Those are all big questions that investors certainly have, especially considering all the third-party data that we've gotten over the last couple of weeks.
Yeah, but the fact that the stock is down about 10, 11% so far this year, and it's lost about 7.5% since the last earnings report, a miss is pretty much priced in at this point. So if you want to look ahead, let's look ahead to the jobs report tomorrow. Yeah. That's going to be, ground zero again for the Fed in terms of what it does next.
But you're looking at the Russell, right? The Russell 2000 is up by 1.7%. So clearly it's sort of the smaller companies. It is the cyclicals. They're really starting to outperform, right? One of the top performing stocks, I keep going back to it, is a logistics company, like the real economy stuff.
Yeah, well, we should point out, I mean, that the best performing, at least of the major indices, are the Dow transports here, and that is on the back of some of the moves you're seeing in C.H. Robinson, some of the other truckers as well, but also the airlines, also the railroads, also a lot of the aggregate makers as well here. So maybe that is the cyclical trade, at least for this one day, as we await those earnings out of Apple. The Dow is going to finish higher by about 300 points, or about 0.9%. The S&P up by about 46 points, or 0.9%. The NASDAQ composite higher by more than 200 points, or 1.5%. And your outperformer on the day, Dow Transports, up 2.5% here on the day, and the Russell 2000 going to close out the day higher by 1.8%.
All right, guys, to some of the individual gainers. Number one gainer in the NASDAQ 100, number three gainer in the S&P 500, drum roll please, is Moderna, which is up about 12.5% in today's session, reported a narrower first quarter loss than Wall Street had expected, and the company also doing a lot of cost cutting, so that helped offset a steep decline in its COVID business. But we've got some new earnings.
Yeah, first quarter revenue for Booking Holdings beating estimates. First quarter gross bookings revenue coming in at $43.5 billion, beating estimates of $42.2 billion. Booking first quarter room nights sold coming in above estimates at 297 million versus estimates of 290.93 million dollars, 93 million, I should say. Booking first quarter revenue for 4.4 billion versus estimates of 4.25 billion, so a beat there as well. And I know adjusted EBITDA also coming in above estimates, 898.8 million versus estimates of 718.6 million dollars.
All right, to Expedia we go. The stock is popping in the aftermarket. Just a few headlines here so far. First quarter adjusted EBITDA of 255 million. The estimate was for 175.2 million, but you are seeing that stock really pop higher here in the aftermarket. Romaine, it's up about 3.6%. We'll look for some more headlines on that one.
WW earnings also out as well here in the most recent quarter. The company reporting revenue that came in a bit above expectations. $206.5 million. The street was looking for $199.5. Net subscription revenue also tracking similar numbers. And as far as the actual number of subscribers there, it looks like pretty much in line with estimates, about 4 million. The street was looking for 4.01 here. Shares not really doing much here in after hours trading. Scarlett.
All right, let's talk about Amgen, the biotech company reporting first quarter adjusted EPS of $3.96, beating the consensus estimate by 2 pennies. In terms of the operating income, that was a miss, $3.08 billion. Analysts were looking for $3.12 billion. The outlook here, full year adjusted EPS anywhere from $19 to $20.20. That is a raise, a higher forecast, because previously it had seen $18.90 to $20.30. So just a shift up in terms of its outlook.
I just want to go back to Expedia for a moment. So it just looks like we're getting some more data out here. Their free cash flow of the first quarter coming in at $2.7 billion. That looked a little bit lighter. The stock is still up pre-market, but its gross bookings for the first quarter also came in a little bit light at $30.16 billion. Expectations were for $30.5 billion. I'm trying to piece together this and booking, as well as MGM and the hotels, and I'm trying to get a macro read on it. I'm not entirely clear as to what that is yet.
Little commentary commentary and context. They say, given the Verbo drag and the rate of acceleration in B2C thus far, we are lowering, the company says, our full year guidance to a range of mid to high single digit top line growth with margins relatively in line versus last year. Despite the slower than expected acceleration, the underpinning of the work we have done on the platform, blah, 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 that they have every confidence in the teams to continue to leverage their capabilities to drive stronger growth. So it sounds like a little bit of a tempering back, pullback of expectations.
Well, that's what I'm curious about. I mean, what does this say about the state of travel right now? I mean,
but everybody's traveling.
Yeah, I mean, we heard from the airlines directly. So, I mean, they basically said that at least for right now, things are pretty good here. But for these third-party booking companies here, are they holding up just as well? What are they seeing that's different?
What are they seeing that's different? I mean, a lot of it also comes down to how much people are willing to go through these third-party websites versus going through the airlines directly, or perhaps using their miles, their credit card points to cash in on that, right? Because we know those are devaluing pretty quickly.
Do you do that anymore? I'm curious. I mean,
do what anymore?
Yeah, totally.
Going through the third-party
sites. No, not that.
No, I do that. I do that.
You go right to the airlines?
I go right to the airlines.
I go right to the airlines.
Okay, well,
no, I don't do that.
Speaking of third parties, let's go back to Booking because we're seeing shares move higher in the after hours. Glenn Fogel, the CEO over at Booking, talking about the strong start to 2024, touting the first quarter year-over-year growth in room nights of 9%, revenue of 17%, operating income of 76%, all of which were ahead of prior expectations. They're looking at higher frequency and more of travelers moving into the upper Genius loyalty tiers. So some movement there.
All right, let's go to Coinbase right now. Coinbase, reporting first quarter revenue of $1.64 billion, topping the average analyst estimate of $1.32 billion. It sees second quarter subscription and services revenue of anywhere from $525 to $600 million. Those are the numbers I'm getting right now. Again, revenue top line, $1.64 billion, higher than the consensus estimate. We have the bottom line number now, $4.40 for the first quarter EPS. Wow, analysts were looking for $1.07. I'm not sure if we're comparing like with like here. That looks too big.
Yeah, stock's still down about 2.5% in the aftermarket. Keep in mind it's had a pretty good bump to the upside here in 2024, up about 31%. 6% of the float is shorted, so we'll wait for a little bit more context around this one to see in terms of that comparison.
Yeah, I'm looking at the numbers now. It looks like definitely not apples to apples, but our team here at Bloomberg will sort that out. But I mean, look, we knew they were going to benefit from all that trading volume that we saw in the first quarter, and that some of that had to, of course, fall onto Coinbase. So I guess wouldn't be out of the realm a possibility that they did have a pretty wide beat.
And that stock is down by over 2%. Are we learning anything, guys, in terms of the stock reaction move and then the numbers that we get? I mean, it does seem like if you underpromise and overdeliver, you do get some kind of pop, but that margin isn't that great. It's not that much of what we've seen, say, in the past.
I'm just going to point out to you right now, Expedia, which was rallying, is now down about 2.3% here in the aftermarket. So we're seeing some rethink in terms of some of the numbers. Just to rehash, first quarter adjusted EPS, 21 cents, was for an estimated loss of 24 cents. First quarter gross bookings, we talked about this, 30.16 billion, maybe a hair light, 30.5 was the estimate. First quarter cash flow was a little light, 2.7 versus 2.82 billion was the estimate. So again, a little bit of a pop to the downside. Now it's down about 3%. So quite a swing here in the aftermarket very quickly, too.
Yeah, continuing also to see Booking Holdings shares move higher by 9.4% right now. Revenue on the top line beat estimates. Revenue on we saw the bottom line beat estimates as well. Revenue coming in at $4.42 billion. Estimates were for $4.25 billion. Still waiting on the company formerly known as Square, now called Block, in addition to Apple coming later.
I want to go back to what Alex was saying. Are we really getting much of a read into the stock price reaction? I'd argue that given the popularity of options, what you're seeing is just a lot of settling of those positions more than anything else at this point.
That's such a good point.
Live Nation earnings crossing the wire as well here. Their revenue in the most recent quarter, guys, looks like a beat, $3.8 billion. The street was looking for 3.3 here. And operating income also coming in slightly above estimates here, though you see the share reaction slightly to the downside here. But I mean, looking at this is 21% revenue growth, a 26% specifically on the concert revenue, if you will, here. And sponsorship and advertising also up about 24%. So pretty much a beat all around, but maybe the street was looking for something more given the share reaction.
Michael Rapino, over CEO and president of Live Nation, saying that global fan demand right now is stronger than ever. I think it makes sense in the wake of Taylor and Beyonce over the last few months.
All right, on to Apple we go, guys, in about 20 minutes or so. All right, that's a wrap. Our cross-platform, a lot of earnings getting through here on our cross-platform on radio, TV, YouTube, Bloomberg Originals, Beyond the Bell. We will see you same time, same place tomorrow.
And as we await those big earnings out of Apple, expected any time now, we're going to walk you through all the other earnings crossing the wire here in after hours trading. Stick with us. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu, post-Fed pre-jobs.
Yeah, a little bit more optimism in the market here. I am Romaine Bostic with a look at how the markets performed on the day. You see the green on the screen behind me, 0.9% on the S&P 500, 2.5% on Dow Transports, and that is the story here. This was the cyclical trade. You look at the biggest percent gainers in the S&P today, you're not going to find a whole lot of tech stocks up there. It was trucking companies, it was cereal companies and the like here, and maybe, just maybe, that is a good thing. Tech, of course, not out of the picture quite just yet. Scarlett Fu, the Bloomberg Magnificent 7 Index having a decent day, 1.8%, though that could change in a few once we get the last of the Mag 7, Apple, on deck.
All right. In the meantime, let's take you through some of the corporate movers on the day. Peloton, at one point tumbling as much as 16% to a record low, finishing the day off about 2.5%, so paring some of its losses. The CEO, Barry McCarthy, said he is stepping down and the fitness company is restructuring. It's going to lay off 15% of its global staff. Now, the company's stock has lost about 98% of its value since its peak in December of 2020. Speaking of former pandemic darlings like a Peloton, Moderna today is the best performer in the NASDAQ 100. The biotech company up about 12.5%. It reported a smaller loss than expected last quarter. Aggressive cost cuts helped offset a drop in its COVID-related business. Now, our top story this hour, and Romaine referred to it, of course, is everyone's bracing for Apple earnings that are unlikely to impress. The iPhone maker is expected to post revenue declines for all its device segments. That'll be the first time that's happened in at least a decade. It's also the least magnificent of the Mag 7 stocks, sliding 10% this year on a cocktail of concerns, ranging from a weak iPhone cycle and struggles in China to missing out on the AI party and regulatory pressures that remain at home and in Europe. Romaine?
All right, and of course, while we await those Apple earnings, quite a few other earnings crossing the wire from DeVito, from Rocket Companies, from Texas Roadhouse, from Amgen, from Coinbase, and a few others as well. Jess Menton and Bailey Lipschultz joining us right now to break it all down. And I didn't mention two of the biggest movers here in after hours trading, Jess Menton. And that are our two travel stocks, but going in opposite directions. Expedia down, Booking Holdings up.
So you are seeing Expedia actually give up those initial gains here. So if you take a look at this stocks, EXPE is the ticker symbol on this, down about 5%. So the biggest thing looking at this is also they've had a shakeup here when it comes to the executive changes. And we knew about this in recent months. So Ariane Gorin, she's actually going to take over the helm for this company on May 13th. And she actually replaces former CEO Peter Kern. And they've also gone through a number of restructuring earlier this year. So they cut about 9% of their workforce. And in Expedia, the big thing, because earlier this year they did warn that they were concerned about revenue would moderate this year because of ticket prices. So if you look at the one-day implied move, though, SERP is the function on this in the terminal. It actually was supposed to be an implied move around 10%. That is kind of in line where we've seen that stock move over the last 2 years. So you are seeing right now ahead of the earnings call, really investors want to hear what does the future look like for it, especially when you think about what's going to happen in the summer travels.
We want to get to some other earnings, but we have to actually have a new kid on the block here, and that is Block, the company formerly known as Square. The share is oscillating between gains and losses here in after hours trading. It looks like in the most recent quarter, adjusted EPS did come in above expectations, 85 cents a share versus street estimates of 71 cents a share. Gross payment volume coming in, I guess we'll call it light, 54.43 billion. The street was looking for roughly 55.6. But an interesting note here, there's Scarlett. They're saying that they have announced a strategic investment in Bitcoin, implementing a Bitcoin dollar cost average buy program. I don't know if they need to get a hat tip to Michael Saylor for that one here, but a deeper push into crypto for Jack Dorsey's block.
Does this just become another proxy for the price of Bitcoin, like MicroStrategy?
You kind of wonder, maybe that's where they're going with this.
I mean, we know that Jack Dorsey is a big crypto fan, but this is interesting given that Block actually has a business that is very relevant in this day and age.
And we had just a little while ago, Bailey, if you want to jump in here, we had Coinbase earnings that came out a little while ago, and there were a lot of people were expecting to see those volumes pick up, and hopefully that would translate into revenue growth and, more importantly, something on the bottom line here. I mean, is there still a lot of interest in this by investors?
I think that people are still interested. When you look at really Coinbase, the argument is you still come back to, is it a proxy for Bitcoin? And also, how can it derive and continue to make money off of those purchases, and how active investors are actually buying pure Bitcoin as opposed to using some of those ETFs, using some of those other derivatives. When you look at the stock, yes, it's down 3% post-market, up 345% in the year prior. Wow. So still giving back some of those gains, as Jess likes to call out when you look at what options we're expecting. 12% move.
And I just interrupt. Just so on Block, we should point out more details on that Bitcoin buy. 10% of their Bitcoin product profit will be reinvested, Scarlett, back into Bitcoin.
So it kind of is like a...
Pretty much.
Right, like Michael Saylor's company. So let's go back to Coinbase for a moment here, because with the advent of the spot Bitcoin ETFs, there's a lot of concern that Coinbase would just become less of a needed platform for a lot of investors. What are we learning based on the results this time around?
Well, when you look at the results, it is kind of a first snapshot, right? So this is the first 3 months that we actually had those ETFs. So whether you're being able to cater to core Bitcoin bulls who would rather have the actual token and put them in cold storage versus people who just want exposure. So when you're looking through the expectations, looking through the guidance, leaves kind of room for what maybe investors would have wanted. Yes, 1Q revenue beat expectations, but when you're looking further down the line and looking into 2Q guidance, subscription and services revenue beating expectations, but still you have to live up to a 345% rally over a 12-month period.
That's a good point. DraftKings numbers just came out. So the betting company sees, let's go with what it reported for the first quarter. Revenue of $1.18 billion, beating the consensus estimate of $1.12 billion. In terms of average revenue per MUP, I'm not sure what that stands for, $114. Analysts were looking for $105.04. So monetizing more per user than analysts were looking for. As for the outlook, the full year revenue is $4.8 billion to $5 billion. It had previously anticipated as much as $4.9 billion, so raising the midpoint of that forecast. However, that guidance excludes the estimated impact of its Jackpocket deal. So there's a couple of one-off items that are not included there.
And also some other earnings also out. This on Cloudflare, of course, we talk about cybersecurity. Those shares down 15% in after-hours trading here. Revenue did come in pretty much in line with estimates, and EPS also did beat on estimates, but the guidance giving people concern. I'm going to read that guidance to you, because the company is saying for the second quarter, the current quarter, revenue of $393.5 to $394.5 million. The top end of that range is the average of analyst estimates. A similar story on their full year forecast, and maybe that's giving people, Scarlett, a little bit of pause.
Yeah. So as we get more results from these B2B software companies, enterprise software companies, Jess, I'm curious to hear from you what you're seeing in terms of companies and their willingness to spend, because obviously cost cuts are a way for them to make sure that they meet their bottom line targets, but we know that there's a lot of investment in things like AI. So can you kind of bridge that for us, what companies are willing to do in terms of their cost cuts, what they're willing to say in terms of their investments in making sure they're bolstering their business?
And that's the big thing, too, when you're thinking beyond just what corporate buybacks are happening. We're seeing those pick up again after 5 straight quarters where we saw a bit of that slowdown. But then also when you're thinking about CapEx and how companies are reinvesting into their businesses, we're starting to see more trends of that, which it has been a positive sign. Bloomberg Intelligence and Gina Martin Adams' team on the dashboard is BI Go, and so you can go to the equity, and they have a lot of different metrics where you can see when it comes to more reinvesting in their businesses, we're starting to see that pick up, and obviously more backward looking when you're thinking about the first quarter, but obviously those outlooks moving forward and how companies want to reinvest, and that gives you more optimism as far as what that means for the economy, because that obviously is what Wall Street analysts want to see, and investors as well, too.
When we talk about the real economy, though, it's kind of a tale of two cities here. Let's talk about steel stocks. U.S. Steel out with their earnings, their first quarter numbers coming in below estimates, $206 million in adjusted net, excuse me, let me rephrase that. Let's go straight to the EBITDA number. Adjusted EBITDA, $414 million. That's a miss. The street was looking for 443. Steel shipments were 3.8 million tons. That's a beat. The street was looking for 3.63. But revenue, total sales coming in at 4.16 billion. That's also a miss here. So a mixed bag here for U.S. Steel, though we should point out this stock right now, Jess and Bailey, really being driven, I think, a lot more by that acquisition that may or may not happen that's hanging over them.
Yeah, M&A potential is really they play there. As you mentioned, that EBITDA miss, especially second quarter guidance between 425 and 475 million, estimates for north of 530. So that's a pretty sharp drop across what Wall Street was looking for. But as you mentioned, really is a proxy for M&A, whether or not the deal to be sold can get across the finish line. When you look at it on a 12-month basis, giving back a lot of those gains and premium around when that deal was first announced, given kind of uncertainty around U.S. Steel being acquired by a Japanese company.
Yeah, well, for what it's worth, the CEO says that we're focusing, of course, on safety as we progress towards the close of our pending transaction with Nippon Steel. So
the close of that transaction? Oh, okay.
Of our pending transaction.
That's very optimistic.
So, yeah, there's a lot of language in there to kind of, hedge every possibility. But thank you, guys. Jess mentioned, of course, Bailey Lipschultz helping us break down all these different earnings, a snapshot of corporate America in the first quarter and what company executives are expecting in the months ahead. We've got more analysis coming up. Apple's earnings report is next up at the midpoint of this hour in about 10 minutes time. We're going to take a deep dive into the iPhone and its other consumer devices with Nabila Popal. She's director of research for IDC. This is The Close on Bloomberg.
All right, we are awaiting those results out of Apple, a quarterly report that most people expect to be bad, but investors really looking for a better sense here, not just of how much those iPhone unit sales drop, but more importantly, what Apple can do to stem the slide. Joining us right now to talk a little bit more about the broader smartphone space here, what people are buying and maybe what they're not, is Nabila Popal. She's Director of Research for the International Data Corporation, which manages, tracks, and publishes data on consumer devices. And Nabila, the narrative over the past few months has been that, well, not everyone's out there buying iPhones, but the smartphone market as a whole is seeing some pretty decent recovery.
Yes, hi, everyone. Thanks for having me. So yeah, absolutely. And it's kind of the inverse of the narrative we were hearing over the last few years, right? Where the whole market's declining and everyone's declining double digits, but Apple was growing very strongly. So now I think what's happening, and of course there's so many different factors at play, right? But I would, highlight two key things. One is that Apple's decline is also a function of the fact that it had grown so much, so significantly. I mean, if you look at the historical data, unit share, it always hovered around 15%, like all the way up to 2019. Mm-hmm. And then it kind of like grew up really fast up to a peak at like 20%. And the reasons for its growth are also kind of now why it's seeing some decline. So in Q1 we just published, we saw close to 8 to 9% decline for Apple, whereas the total market is finally showing that kind of growth.
Nabila, we were just showing some data on the screen, data from IDC, which shows Apple's share of the smartphone market. I think we were showing the worldwide one, which I think puts it at around 20% here. That's for 2023. Yep. That's been up pretty much year over year for the last few years here. Is that going to go down for 2024, or is that going to stay about the same?
So that's exactly what I wanted to point out. Just because, we did see some decline in Q1, we're not expecting Apple to go down, and certainly not to those 15% levels where it was at. It has gained, tremendous share. And yes, it will, because there's the Android recovery is so strong on the back, just because Android is coming off a very tough 2 years. We're seeing some, numbers drop for Apple in Q1, but for 24, we expect it to hover around 19 to 20% as a share.
So Nabila, the big question a lot of people are thinking or asking is, Apple's iPhones haven't really given people reason to upgrade their devices, and the big issue is, will an AI-enabled smartphone do just that? What can you tell us about how far along Apple is with any kind of AI smartphone versus its peers?
So, I think me, like anyone else, doesn't have a peek into Apple and exactly what they're doing. But of course, if the rumors are right and if all the insight we'll be hearing are true, they are going to probably ramp up the whatever plan they initially had, right? Just because there's been so much negativism coming from consumers and the media and the like about why Apple is so late to the game. I mean, every single Android player has launched and benefited so much from its AI-driven smartphones. And not to say that iPhone, Apple can't, but they've certainly taken their time. And we're actually very optimistic and eager next, we have a new event coming up in a few days, and also in June with the new launch to see what Apple announces. And we're expecting them to announce some, AI-focused features on their upcoming flagships. And actually, on the AI point, it's also one of the driving reasons why Apple's also gone down in China, because the China market, which had, of course, again, contributed to Apple's growth, right, in the last years, the Chinese consumers are really, especially in the premium segment, are really looking for more features like AI, and AI is becoming a driving decision for what brands consumers choose.
Right.
So, I won't drum on the Huawei, point that's been talked about so much, but AI is a big other factor, and we hope if Apple does,
Nabila?
lead to that, yes.
Okay, we got to leave it there, but thank you very much. Nabila Popal is Director of Research for the IDC, taking a look, of course, at the smartphone market, the device market overall. Apple results just moments away.
Apple earnings crossing the wire right now. Let's go right to it here. Revenue in the most recent quarter, iPhone revenue. Let's start there. $45.96 billion, Scarlett. That's a beat. The street was looking for roughly $46 billion in iPhone revenue. Wearables revenue, $7.91 billion. That's a 9 to 10% drop year over year. It's also below what the street was looking for at $8.29 billion. Greater China revenue coming in at $16.4 billion. That's an 8% drop year over year, but coming in above what the street was looking for, roughly $15.8 billion. Overall, you add it all together, Scarlett, in the fiscal second quarter, revenue came in at $90.75 billion. The street was looking for $90.33, so relatively in line with estimates.
Right, and this was priced in that Apple would report a revenue decline, and in fact, this marks the fifth quarter of negative sales growth in 6, and you see it reflected in the stock, which has lost about 10-11% so far this year and down about 7.5% since the last earnings report. So the big question here is what it does to kind of hold things over until things get better. Yeah. Apple is buying back an additional $110 billion of shares. It's also boosting its quarterly dividend. So it's using its free cash flow, all the cash that it generates, to return some of that to shareholders.
Yeah, absolutely here. And just to get you the bottom line number here, it looks like they did keep costs under control. EPS did come in at $1.53 on a year over year basis. That's only a penny more than what they made in the quarter a year ago. And it's 3 pennies more than what the street was looking for on average here. And operating expenses, we'll just call it in line with estimates at about $14.4 billion. All right, Emily Chang joining us right now, the host of the Bloomberg Original Series, joining us right now, just off the phone, I'm told, with the CFO of the company. What did he have to tell you, Emily?
Hey there, Romaine. Thanks. Obviously, very good point that a lot of the bad news was already priced in. Therefore, you're seeing that reaction in the stock and revenue beat, iPhone beat, but you are seeing some still significant declines across product categories. With the iPhone in particular, Luca Maestri told me one of the big difficulties here is a difficult comp, a $5 billion disruption that was due to some supply chain issues that led to some delayed sales, which means, again, the comparisons are a little more difficult. But the headline from Mark Hall really was that he said, we expect to grow low single digits in the June quarter, and they're going to be talking about that a little bit more on the call. So all the folks out there wondering, is Apple still a growth company? At least for the June quarter, Apple is predicting they will be.
Let's talk about China. Romaine was mentioning earlier, Greater China revenue in the second quarter, $16.37 billion, down about 8% from a year ago when analysts were looking for $15.87 billion. So that is a better than expected print for Greater China. But that region, that market for Apple has been a source of a lot of concern for investors. Did he give any color on what their prospects are in China?
Absolutely, Scarlett. You're looking at a $1.5 billion decline in China and APAC. Separately, in China specifically, he talked about that disruption. You're seeing some impacts there. But he said, we're actually happy with our results in China. Specifically, he said this is the most competitive smartphone market in the world, without a doubt. But we feel good about the results. He talked about Tim Tim Cook being in China recently, the new store they opened in Shanghai, the level of enthusiasm for the brand being very strong, the fact that they had the top-selling smartphones in the quarter. They set a record for upgraders. So he said the reality is very different from what you read at times.
So, Emily, I'm scouring right now through these press release and presentations to get all those fat numbers that we're supposed to see off that Vision Pro headset. I don't know if you have one of these things here, but talk to me a little bit about the wearable strategy. I mean, I'm kind of being facetious. We know it did not quite take off as quickly as maybe they expected here, but are they standing by that strategy? What did Luca tell you?
I've tried the Vision Pro and I thought it was awesome, but I didn't buy one myself. So maybe that tells you something. You know, the wearables category was weaker despite the launch of the Vision Pro and some of the mixed reports about the Vision Pro. We talked about that, and again, he said it's a tough comp. He said that last year they released some new AirPods, some new watches. Those were very popular, but overall that they're still very excited about the category. It's grown a lot over the years. In fact, it's doubled in revenue over the last 5 years. So that launch compare was tough. And we also talked a bit about AI. Obviously, WWDC, their big developers conference is coming up. They're going to be talking a lot about AI there. He said they think it's a great opportunity. It has a lot of potential. It's where they're making significant investments. And this is going to be really important for Apple. Can they build in new features, better software that gets people really excited about upgrading, replacing, or even, coming over to iOS as a platform?
Absolutely. Emily Chang, host of the Bloomberg Original series, The Circuit there, just off the phone with the CFO of Apple as those earnings cross the wire right now. We should point out this is still a cash-generating machine. Current assets right now, Scarlett, $128 billion right now on the balance sheet. Gil Luria joining us right now, Managing Director and Senior Software Analyst at D.A. Davidson. He has a neutral rating on the shares. And Gil, while everyone's so focused on the actual dollar numbers coming out, I do want to start off with the idea of this installed base that Apple has, whether it's obviously with the iPhone and iPads, but also, of course, with the Mac and whatever sort of crumbs they picked up with Vision Pro. In theory, that still holds. And in theory, that should generate a certain amount of services revenue. Is that going to be enough to make up for any slump in actual device sales?
Not quite. Because the units still have to grow somewhat or at least be stable for that services growth to drive any meaningful overall growth. So we just got the bad news. The bad news is iPhone 15 was not a good upgrade cycle. It really didn't add much in terms of feature functionality, and it comped a really tough quarter a year ago. So we got the bad news out of the way. You're going to get some relief. But as you've been discussing this hour, really we're all now looking ahead to iPhone 16, and specifically, what is the AI functionality that it's going to bring to us? Are we going to get a teaser for that today, or are we going to have to wait next month for WWDC?
Well, that's right. Well, that's what I'm curious about too. I mean, we have the conference call coming up at the top of the hour. Whether they want to reveal something then or not remains to be seen. They have an event next week as well, Gil, that I think some people are kind of looking to and saying, okay, are we going to get more than just an iPad announcement? Are we going to get an articulation of that AI strategy? When do you expect to get that?
So I would expect the May event to be an iPad only, just based on the logo that they put in the invite. Apple has traditionally not front-run its announcements, and so they may not give us anything either today or at the iPad event. We may have to wait till next month, but they always do give us something new and exciting and fully formed, which is what we'd expect to get at WWDC. We're talking about things like instant translation, advanced photo editing, summarizing conversations and documents. We may get some of those things. And importantly, and this is something to look for, some of these technologies may be native to the handset, as opposed to being services that like we're using today, which are pinging a data center, which means they're slower. The big push forward that Apple can have is if they build these capabilities into the handset, making them not only faster, but more personalized to what information the handset knows about us specifically.
So, Gil, we were talking earlier about how much cash Apple has on hand. Plenty of it, and it's going to be increasing its quarterly dividend to 25 cents from 24 cents and buy back an additional $110 billion of shares. Is that kind of return of cash to shareholders going to appease investors enough while we wait for this AI-enabled smartphone, iPhone 16 or 17, whenever it does come along?
It may not be enough in itself. They really need to grow their earnings at a faster rate. If you look backward looking, their earnings didn't grow very fast the last couple of years. Again, for a company this big, the frame of reference is the S&P 493, right? Everybody but the Mag 7. Mm-hmm. The rest of the S&P 500 grew earnings faster the last couple of years than Apple did, and Apple's trading at a higher multiple. For Apple to maintain this multiple, it has to grow earnings faster than the rest of the companies in the S&P 500. And in order to do that, they at the very least need to buy back shares, but they also need to be able to expand profitability by growing top line and expanding margins.
Okay, so it all comes back to being able to expand its top line primarily through devices because that's the bulk of its business. Is Apple's weakness in China cyclical, Gil, or structural?
It feels like Apple's just gotten ensnared in the U.S.-China conflict. The actions there to limit the purchasing of iPhone by certain government employees or government agencies is a big part of what we're seeing now. Some of it is feature functionality, but some of it really is politics, which is, by the way, why things aren't that bad in the entirety of their China business, because this is really an iPhone-specific issue. Mm-hmm. It doesn't necessarily impact wearables, Mac, iPad, and services as much as it impacts the iPhone. Yeah. But there, it's really a matter of being caught up in the politics of U.S.-China relationships, which is not good for Apple, but it's almost inevitable given their size.
I'm curious, Gil, and this is more of a longer-term, sort of bigger question here about Tim Cook and the leadership of this company. He's done a phenomenal job. We're coming up on his 13-year anniversary as CEO here. He's 63 years old. There's been a lot of discussion about some of the executives who have left recently, and the idea of whether this is a company, given its maturity now, whether it might be actually time for a change at the top.
If the stock continues to underperform the other mega caps, that you're going to hear more and more of that. But that doesn't necessarily have to be the case. Again, we have two things that we can now cling to going forward for Apple. One is, will they introduce compelling generative AI capabilities? There's a decent chance that they will. And then there's that whole new platform that they've introduced, which is a real breakthrough in innovation. You mentioned earlier that maybe you didn't buy a Vision Pro, but we were all blown away when we put it on. And we all got a glimpse of a whole new platform and a whole new level of innovation that Apple is uniquely positioned to offer. There's really very few, if any, companies that can offer spatial computing at the level that Apple does. Because when you put the Meta Quest 3, with all due respect to Mr. Zuckerberg, you don't have the same experience as you did when you put the Vision Pro on.
Well, Apple just needs more people to buy into that idea. For now, it's not quite there yet. Gil, really appreciate your joining us today. Gil Luria over at D.A. Davidson with the instant analysis on Apple results. And of course, Apple right now moving up about 5.5% in after hours trade. And of course, we've had a blizzard of companies reporting results in the last half hour or so, 40 minutes, including Block. You can see the stock moving up about 6%. It's going to flip 10% of its Bitcoin profit into Bitcoin investments. Maybe it's going to be like a micro-strategy?
Well, investors seem to like it, up 6%. I'm not sure what that strategy is, but I guess if Michael Saylor and MicroStrategy can ride that wave, why not Jack Dorsey?
Right, why not, indeed. All right, Booking, not Bitcoin, Booking up about 5% as well as it reported first quarter revenue beating analyst estimates, travel demand clearly remaining fairly strong there. Coinbase down about 3% right now. Speaking of Bitcoin, its profit was certainly helped by all the record highs that we saw in Bitcoin, but that stock currently down.
Yeah, and then keep an eye on those cybersecurity stocks. Cloudflare dragging that whole sector lower. We'll be back in a moment. This is The Close on Bloomberg.
All right, Apple shares are the most actively traded stock by value in the aftermarket. They're currently up about 6.4% at 184.07. Of course, Apple did report sales fell less than feared last quarter, and that its results in China were better than had been feared. Let's break things down now with Anurag Rana, Bloomberg Intelligence senior tech analyst. Apple also said it's boosting its dividend and adding to its buyback program. But your take here is that the stock is moving not on any of those factors. It's something else entirely.
Yeah, I think it's the guidance that I just read on the wire that the growth rate for the third quarter is going to be low single digits, and I think consensus was roughly around somewhere in the 1% to 2% range. So I think that's a good sign, which means the growth rates is moving in the right direction rather than estimates going down for the last several quarters. I think it seems to be potentially a U-turn over here.
If that's a U-turn, what is that U-turn predicated on, Anurag? Do you think that is going to be on an uptick on hardware sales, or is this more services revenue? What?
Yeah, I think if I again, we'll find out all on the conference call, but if I was to guess right now, it would be driven by services and perhaps not as bad as decline in products as we have seen in this quarter.
When we talk about services, that's really about monetizing the user base that Apple has cultivated. It's 2 billion plus. How loyal, Anurag, is that user base? Does Apple really need to deliver cutting-edge AI when it releases its next iPhone 16 to keep these users spending, to keep them from moving to other ecosystems?
Yeah, it's our thesis that it's the ecosystem that's really holding this together, frankly, because on the hardware side, they have never been on the cutting edge over the last few years. It's always been other providers. So really that the services is holding this together. But frankly speaking, the services alone is not going to be enough. They really need to come out and showcase some really cool hardware, at least on the iPhone side, this winter, if they have to go out and change the narrative of the stock from something value to a quasi-growth stock.
Well, at least based on the share reaction here in after-hours trading, it looks like at least the foundation for shifting that narrative might be underway. We've got an event next week where they're expected, if you believe Mark Gurman, to announce a new iPad. You have the developers conference coming up where most people expect a better articulation of that AI strategy. Do you think any of those events could be a potential upside catalyst as well?
Yeah, I think the June one is going to be really better because that's the one that is going to completely change the narrative, either on one side or the other side. Because there is a lot of expectations about that particular event going in, and we just have to see what they come up with.
All right, Anurag, really appreciate your joining us. Anurag Rana of Bloomberg Intelligence, looking ahead to what Apple might announce, not just next week, but at the Worldwide Developers Conference in the next month.
I'm pretty sure he has the best beard at Bloomberg Intelligence.
Yeah,
too,
I've been keeping track of it. Looks pretty good.
Yeah, so I'm envious. So.
Well, you can also model yourself after that.
I could try.
Work towards it.
I wouldn't look as good as him. No.
All right, let's shift gears and take a look at our Muni moment. We're sticking with tech because a pair of California lawmakers are targeting Amazon, Google, and Meta. They've introduced a new bill that would require those three companies to pay a 7.25% tax on any California advertising revenue that exceeds $2.5 billion. And they estimate that this measure would raise about $500 million a year.
I love this, not because I think it's a good idea, but I love it because this is so California. Just listen to this. Senator Steve Glazer, who we quote in a great Bloomberg Law story out there, they're calling it a data extraction mitigation fee. And I'm going to quote this. This is an exact quote. We've had two gold rushes in California about 150 years apart. The first extracted gold from our hills. The second extracted data from our people.
Well,
that's very dramatic.
They're comparing this to fees that they would levy on polluters, for instance, or developers to mitigate their impact. So the money would go towards California newsrooms.
I'm not. It's not that I'm unsympathetic to this. I know they need to raise the money, and they do feel like that maybe these companies haven't paid their fair share. But think about all the companies that have tucked tail, gotten out of California because they feel like it's not business friendly, or they feel like the taxes are too high, et cetera, et cetera. And I'm not saying there's going to be a mass exodus over this, but it's just one more thing that companies there are going to have to look at and think, do we really want to stay here?
And then they're going to go to Texas or go to Florida.
Yeah, or they come to New York.
Taxes are just as high here. Come on, who are we kidding?
I got to promote New York. All right, stick with us. A lot going on today, a lot going on tomorrow as well, including a big jobs report. We're going to set you up for what to watch when we come back after the break. This is The Close on Bloomberg. All right, it's been quite a week. We had that Treasury refunding announcement. The Fed decided and Apple reported, but one big event still on tap, and that's tomorrow when we get the U.S. jobs report, 8:30 a.m. Washington time. Stuart Paul joining us right now over at Bloomberg Economics. What are the expectations for tomorrow morning?
Consensus estimate is calling for 240,000 jobs added during the month of April. You know me, I can't help myself. When we take our bottoms-up analysis all the way through, we're only estimating about 200,000 jobs added. We are also expecting...
You say only, but that used to be good, 200,000 jobs.
It is good.
Yeah.
It is good. I mean, if we compare it to what's consistent with population growth, excluding an immigration wave, we would typically think that about 100,000 would be the baseline. So 200,000 is still a lot, certainly a step down from the 303,000 we saw last month. We're expecting a weaker household survey, and in fact, we do expect to see an uptick in the unemployment rate to 3.9%.
Okay, so those are the big two headline numbers. But of course, the Fed is going to be watching inflation, and that means wages. And we know California raised its minimum wages for fast food workers. Do we expect to see a lot of wage pressure, therefore?
I'm expecting a little bit more wage pressure than we saw last month. I'm expecting average hourly earnings to tick up 0.4% on the month. We are expecting to see average weekly hours worked holding steady at 34.4 hours per week. So that should keep average weekly earnings also in the 0.4% growth range. But as we saw in Q1, we saw higher unit labor costs, wage pressures, and the effect of higher wages are mounting as an inflation tailwind.
And overall, we're not expecting any change in that unemployment rate, right? Still pinned below 4?
Still pinned below 4. We're expecting an uptick to 3.9% from 3.8. 4% seems to be the threshold among bond traders who are really looking for that opportunity.
Stuart Paul over at Bloomberg Economics. Full coverage by Team Surveillance tomorrow morning, 8:30 a.m. Washington time. The latest U.S. monthly jobs report. Quite a few other things going on around the world, Scarlett, that we have to keep an eye on, including, I know you keep a close eye on this, a big rate decision out of Norway.
Norway, the Norges Bank coming out with its decision. It's seen holding at 4.5% for a third straight meeting. Did you know it was at 4.5%?
No, I didn't actually know that's what the Norway flag looked like either, but we all learn something new every day. Let's move on here. We get some earnings as well.
Yes, Société Générale, SocGen, of course, in Paris, Credit Agricole. So we're going to get European banks telling us what they're hearing. What I'm really interested in, of course, is Hershey's, because what are they going to say about price increases in the face of surging cocoa futures? Yeah,
and we spoke with the Mondelez CEO earlier, and he was acknowledging that. He said, unfortunately, they're actually hedged for the full year, but not into 2025. So I am curious to see how Hershey's pivots around that. Of course, we do get the big economic data, 8:30 a.m. Washington time. That jobs report, I mean, that's going to be pivotal, right?
Yes.
Because, I mean, I know everyone focused on inflation, but it's the labor market that's driving a lot of that.
Absolutely, and we know that immigration has also affected the jobs picture in the United States. We were talking earlier about the consensus estimate of 240,000 jobs added. The range, though, is anywhere from 145,000 to 280,000. It's pretty wide.
And of course, after we get that, our very own Michael McKee is going to have a chance to sit down with the Chicago Fed President Austin Goolsbee. So we'll get some relatively instant reaction here as to how the Fed interprets that data.
Right. I'm willing to bet he's going to say that they need to wait for more data.
All right. Well, that does it for us here on The Close. A busy day tomorrow. Please tune in. Start early in the morning with Bloomberg Surveillance. You end it with us on The Close. And you know what? You can end it even later. Balance of Power coming up next, right here on Bloomberg.